In the UK government budget, spending on the state pension is the second largest item after health. In our 2025 Fiscal Risks and Sustainability Report, we cover 3 risks to the public finances coming from the UK pension system. The direct cost of paying the state pension to those entitled to it, the risks to the public finances from inadequate private pension saving, and the potential impact of changes in the private pension market on demand for gilts. Spending on state pensions as a share of GDP has risen from around 2% in the mid-20th century to around 5% in 2024-25. Our long-term projections estimate the cost of the state pension could rise further to nearly 8% of GDP by the early 2070s. Population ageing is one key driver, but so is the cost of uprating pensions each year by the triple lock, which is the highest of inflation, earnings, or 2.5%. The design of the triple lock means the public finances are exposed to shocks in the annual rate of inflation and earnings growth, and higher than expected volatility in both has meant that, since its introduction in 2012, the triple lock has already cost around 3 times more than expected, at around £15 billion by the end of this decade. To illustrate the risks around the long-term outlook for the state pension system, we look at alternative scenarios for both life expectancy and the future volatility of inflation and earnings. Our higher life expectancy scenario, in which people live an extra 3 years on average post-65, results in there being almost 2 million more pensioners in 2070 than in our central projection. This could raise state pension spending further by 0.7% of GDP compared to our central projection. And in terms of the impact of the triple lock, our more volatile scenario sees the variation in inflation and earnings growth experienced in recent decades persist over the long term. This could increase state pension spending a further 1.5% of GDP above our central projection. Turning to private pensions, the 2012 policy of automatic enrolment into workplace pension schemes has significantly increased participation in private pensions. However, there are still gaps in coverage, and some groups, such as the self-employed, risk not saving enough for an adequate retirement income. This could put pressure on future governments to support individuals with insufficient savings when they reach retirement. A final source of fiscal risks coming from the pension system is a change in the structure of private pension schemes, which has implications for the overall demand for government debt. Pension funds held almost 2/3 of UK debt, known as gilts, at the end of the last century, but that figure has now fallen to around 1/3 of total gilt holdings. The last 30 years have also witnessed a shift in the structure of private pension savings from defined benefit to defined contribution schemes. Defined benefit schemes typically hold a much higher proportion of UK gilts in their investment portfolios than defined contribution schemes. This means that as the defined benefit sector continues to decline, we expect there to be less demand for gilts from UK pension funds. From around 30% of GDP today, we expect total pension scheme holdings of gilts to fall to just under 11% in the early 2070s. Lower pension demand for gilts will mean the government needs to attract other kinds of investors to buy their debt, like overseas buyers. These investors will likely demand higher returns to hold these gilts. Assuming government debt remains at around 100% of GDP, we estimate this could increase the government's debt interest costs by up to 0.8% of GDP, or £22 billion in today's terms. Read the full report on our website at www.obr.uk.